Hey everyone, welcome back to Corporate Decoder, the place where we crack open those confusing financial reports. And unlike this company, we aim to be clear and profitable. Today we are diving into the latest quarterly report from G.B.T Technologies Incorporated, or GT as you might see it on the stock market. Before we start on this financial journey, if you love getting straight to the point insights from these dense corporate documents, smash that subscribe button. We also have a great Discord community where we break down even more financial news linked in the description, so join us there. Alright, so this report is for the period ending the 30th of September of 2025, so we are looking at the company's performance up to the end of the third quarter this year. The big question for any company is, how are they doing financially? Are they making money? Are they growing? Or are they struggling? Let's start with the big picture on the balance sheet. As of the 30th of September 2025, the company reported total assets of just $7,090. That is a remarkably small number for a publicly traded company. Now look at their liabilities. Total current liabilities jumped to over $10 million, meaning the company owes more than it currently has readily available assets to cover. Specifically, the accounts payable and accrued expenses are a huge chunk of that, close to $1.4 million. And then there is another $3.1 million in related party payables. When we look at the equity section, we see a huge number of authorized shares for common stock, over 30 billion. But the actual issued and outstanding shares are also massive, over 18.4 billion by September 2025. This dilution of shares is something to watch. And then there is the accumulated deficit. This is basically the total of all the losses the company has ever incurred minus any profits it might have made. As of the 30th of September 2025, this number is a staggering negative $295 million. That shows a long history of not being profitable. Let's look at the income statement for the 3 months ending the 30th of September 2025. The company reported a net loss of over $180,000. Not a great outcome for the quarter. Their total operating expenses for that quarter were $78,000, which is down significantly from nearly $200,000 in the same period last year. This reduction in spending is attributed to limited cash flow restricting business expansion. The other income and expenses line shows a negative $102,000. This is a big change from the previous year, where they had over $6 million in other income. The report explains this is largely due to a decrease in derivative liabilities, as convertible notes were amended to have fixed conversion features. That sounds like a move to simplify their financial structure and potentially reduce future volatility. Looking at the 9 months of 2025, they also posted a net loss of nearly $500,000. Comparing this to the same period in 2024, which showed over $14.5 million in net income, really highlights a significant downturn. Again, a big part of this swing is that change in other income from gains in 2024 to losses in 2025, mainly from those derivative liabilities. Now let's talk about cash. For the 9 months ending the 30th of September 2025, their ending cash balance was a mere $813. This is incredibly low and raises serious going concern questions, which they do acknowledge right in the report. And for operating activities during those 9 months, they actually had a small positive cash flow of just $688. This came from a mix of their net loss offset by increases in accounts payable. It is essentially a rounding error in the grand scheme of things. They are not generating meaningful cash from their core business operations. The company does hold some marketable securities totaling $6,000 as of September 2025. Primarily, these are investments in Avive. Diving into the debt, we see significant amounts of convertible notes. A major one is owed to Eagle One Corp for over $4.8 million. The terms of these notes have been amended multiple times, including recent fixed conversion prices, which is a good sign for clarity, but the underlying debt is still substantial. There is also a convertible note to Glen Eagle for about $375,000. This again shows a history of financing through debt that can convert into equity, and another related party convertible note to Stanley Hills LLC for almost $500,000. They also have an SBA loan totaling $350,000. It is important to note that the company has had difficulty making payments and is seeking hardship modifications, which adds another layer of financial uncertainty. Their accounts payable and accrued expenses have risen to over $1.3 million. This includes $457,000 in accrued interest alone. The related party payables are also very high at over $3.1 million. This suggests a significant reliance on entities or individuals closely connected to the company for funding or services. Digging into the detailed notes, we find information about their preferred stock. For example, Series I preferred stock has a hefty stated value of $35,000 per S-share and is convertible. This is a common way for companies to raise capital from investors who want certain preferences or rights. Now, this is a really interesting accounting point. They mention right in the risk factors that they do not accrue or capitalize development costs as required by us generally accepted accounting principles. This is a major red flag. It means they are likely understating their expenses and overstating their profitability if they were following the rules. This could lead to significant adjustments if an auditor were to properly apply GAAP. Their internal controls are also flagged as not effective. They acknowledge a lack of resources and staff for proper separation of duties, which is common for smaller companies, but still a significant weakness. They are relying on consultants and external auditors to help bridge these gaps. The risk factors section really paints a clearer picture of the company's struggles. They explicitly state that they have not generated positive cash flow from operations and that their ability to do so is uncertain. This is a critical warning sign for their long-term survival. They also state they will require additional capital to support business growth and operations. They estimate needing around $10 million and warn that this capital might not be available on acceptable terms or at all. This is a direct admission of a significant funding challenge. For investors out there, their common stock trades on the OTC market under the ticker symbol GTECH, and they warn that trading on the OTC can be thin and volatile. This means it can be really hard to buy or sell shares without significantly impacting the price. So what is the story here, GBT Technologies Inc? Is facing significant financial challenges. They have a massive accumulated deficit, minimal cash, and substantial liabilities. Their primary source of funding appears to be debt and convertible notes that often come with complex terms. They are also not following standard accounting practices for development costs, which is a serious concern. This all points to a company that is struggling to find a profitable path forward and is heavily reliant on external financing. The lack of positive cash flow and the acknowledged need for substantial future capital raise serious doubts about its ability to continue as a going concern. What is your take on GBT Technologies' financial situation? Will they be able to secure the needed capital, or are they heading for serious trouble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more deep dives into corporate filings. And again, join our Discord community linked in the description for more discussions. Thanks for watching, and we will see you on the next episode of Corporate Decoder.